All right, good morning, everybody. My name is Luke, and this is the Option Bomb. And today we are discussing Marvell and it getting added to the S&P 500. Now, if you're new to the show, we're going to talk about the headline. Then we're going to talk about the core thesis, and we're going to finish up with the actual trade. So let's get into it. So Marvell just got added to the S&P 500 on Monday, and the stock, man, this thing was already up 210% this year. The news Monday morning hit, and Marvell jumped another 10%. But here's the part most people are missing. The actual forced buying, right? Because we're playing the forced buying event. It hasn't even happened yet. That's going to happen on June 22nd. So that means every passive S&P 500 fund, every index ETF, every portfolio that tracks the benchmark, they all have to own this stock. And right now, guys, we are sitting in the window between the announcement and the forced buying date. So today I'm going to show you three things. Why Marvell is up 210% on the year. What S&P 500 inclusion actually does to a stock. And the specific option setups I'd be looking at before June 22nd. Down in the description are the timestamps. Watch the whole thing from here or click on the spot you're interested in. Because this is not a long-term valuation pitch. This is a time-sensitive trading setup. So let's get into it. So guys, most people here added to the S&P 500 and think it is like a prestigious thing, but it's not. It is a forced buying event. That is how we need to frame it. That's how we need to look at it. So the S&P 500 is the benchmark for trillions of dollars. We're talking index funds, ETFs, pension funds, and 401ks. And when those funds track the S&P 500, they don't get to decide whether they like Marvell or not. They have one job, and that is to own the index, right? In the right weighting. So when the S&P announces that Marvell is being added, effective June 22nd, every passive fund that tracks the index suddenly has a problem. And that is they don't own enough Marvell. So by June 22nd, they have to fix that. And that creates structural demand. Not opinion-based demand and not, oh, this chart looks juicy type of demand, but mechanical demand. Now, does that mean the stock is going straight up? Of course not. Right? The market has already started pricing this the second the announcement hit. And that's why Marvell popped an additional 10%. But the actual buying window, guys, it is still open, right? It is open for 12 more days. And historically, the window between announcement and inclusion can create continued pressure of passive funds, hedge funds, and front runners all positioned around the same date. And that date is June 22nd. So now the question becomes, why is the company getting added to the S&P in the first place? And why is the market willing to chase it after a 210% move to the upside? And is it still bullish? Which normally when a stock gets added to the S&P, it is a bullish signal. Is it still bullish even though it's up so high? So in order to understand that, we have to look at Marvell as a company. Because remember, when we're trading stocks and options, these are companies with real products making real money. And Marvell is a semiconductor company, but not like Nvidia is a semiconductor. They are not selling consumer GPUs. They are selling the infrastructure that makes AI data centers work. And when Amazon, Google, and Microsoft and Meta build massive AI clusters, they need more than GPUs. They need networking chips. They need custom ASICs. They need optical interconnects. They need the infrastructure that moves data between racks, servers, and chips at insane speeds. And that's where Marvell fits. So this is not a hype-only story. Because 3 weeks ago, Marvell launched the Teralynx T100. Go look it up if you don't know what that is. It's a 102.4 terabit per second AI optimized switch built on a 3 nanometer process node. So let's have that in plain English. One of the fastest, most energy efficient data center networking chips in the world. And it is built specifically for AI training clusters. Their most recent quarter, right, Q1 fiscal 2026, came in at 2.4 billion in revenue. They beat the estimates, and data center was the primary driver. So the market sees this company and says, AI infrastructure is not slowing down. Data center spending is accelerating. Marvell is selling into that build out. And if this trend continues, this company could be much larger 3 years from now than it is today. That's why it's up 210%. But now we need to talk about the problem, because this is where a lot of traders get themselves into trouble. and that is this stock is not cheap, right? Marvell's trading at 99 times trailing earnings. 99 times! That is massive. And for context, the 5-year median PE on this stock is around 30. So the market's not just pricing in growth, it's pricing in near perfect execution. And I understand why, right? We've seen it before. When a company gets tied to a secular growth wave, especially AI infrastructure, old valuation anchors can break, right? We saw it with NVIDIA. I mean, I personally kick myself in the face every day. I could have owned NVIDIA at 30 pre-split, $30. I was trading it, right? I should have just bought and hold that sucker. But now, I mean, that valuation model, insane. We saw it with AMD, and now we are actually seeing it with Micron. And Marvell is now in the mix. It's getting the same treatment, guys. But we need to understand what we're buying. It's not a cheap stock. It's not a value play, right? This is a company where the market has already decided the AI data center build out is real. And Marvell is a major beneficiary and execution is going to be strong. That's what they've decided. And if that thesis holds, the stock will keep working. But if it stumbles, if one quarter disappoints, if hyperscaler capex slows down, if a competitor launches a better chip, if the AI infrastructure trade gets crowded and unwinds, the stock does not drop 5%. It could reprice 30 to 40% fast. Now, that doesn't mean we can't trade it because we're going to trade this sucker. I already have a strangle on this thing, right? But it means we need to know exactly what kind of trade this is, right? This is not a buy it because it's cheap. This is trade the catalyst, respect the risk, and know the exit before you enter. So there are 3 things, guys, working in Marvell's favor right now, which makes this setup interesting. First, forced passive buying. Every S&P 500 index fund has to own this stock by June 22nd. That demand does not care about valuation. It does not care about the PE ratio because it is structural. Second, we're going to front run this thing. Hedge funds and active managers know how this works. They know passive funds have to buy. So they often step in early, ride the pressure, and look to sell into the inclusion event, which means they are buying in this window. And when it hits on the 22nd, then they're going to sell, right? Because that will be just the natural trigger for this. And that will create this extra demand before the actual date. So that's why in this window, we are bullish, okay? And third, the AI CapEx tailwind is still there, right? Amazon just signed a multi-billion-dollar deal with Corning for optic fiber. That's not random. That's data center expansion. And every time hyperscalers build more AI infrastructure, companies like Marvell stay in the conversation. So what makes this trade interesting is not just the story, it's the calendar. Because number one, we have a defined catalyst, right? June 22nd date for S&P 500 inclusion. It gives traders something rare. We have a date, a window of time, and a reason to structure risk around a specific event. And that's why I think options are worth looking at here. And guys, I gave you the whole narrative on Marvell and the AI trade because AI is hot right now. We have a catalyst that's going to push the price to the upside on a stock in a sector that's hot, right? Now, that tells me, yeah, maybe it's not going to go to the moon, right? This thing's not going to shoot up forever, but it is a bullish trade setup. It's also not risk-free, right? And we're not doing this setup because Marvell is cheap. We are doing it because the timing is defined. So now I'm going to pull up the chart. We're going to use Thinkorswim and TastyTrade to discuss 3 different ways that we can play this thing. All right, so I've got the chart pulled up, and we can see that right after that announcement, guys, this thing ripped from about 220 all the way up to 324. That is a massive, massive move. That's like dang near 40% on the news. And now it's pulling back. However, guys, I still think this thing is bullish, right? And now it's maybe not going to break to new highs, but I definitely don't think it's going to crash down below where it made that move, like 200, 220 might even be safe. So the first thing we could do, and there's 3 different setups. I'm just going to list them out right here. We could go for a long call, right? We can go for a long vertical spread, or we can look at selling a put. Okay, my preference is number 3, but let's talk about them all. So number 1, if you only have an account where you can buy calls or buy puts, we could look at buying a long call. At this point, I don't know if I would. Maybe if it comes and fills this gap, I would looking at buying a long call on this. But right now, this thing just moved too far, too fast on that news, and I would hesitate to buy a long call before this gap is filled, right? So let's just, the other thing too is Marvell has an 89.7 IV rank, an IVR, which means IV is elevated, and we are going to be paying a hefty premium on any call options that we buy. So that is an option for a bullish move to the upside, but looking back at the chart, it'd have been nice if we got it around here, but we didn't. So I would say respect the gap. Long call is probably off the table. The next thing we could do, guys, is we could sell a put or a put spread, which might be what I would do. So I probably would look at let's go here. Let's see what we got here. So we could sell the 230, buy the 225. We'd collect $1.13 as long as it stays above 230. If we want to go something wider, maybe respect the gap, we could go 220, 210, get $1.50. That's not a very good risk reward ratio because the IV is so elevated. So guys, that is an option. It caps our upside. It also gives us a pretty wide risk. I like to do like collecting 33% of the width of the strike if I'm going to sell a call or a put spread. These options aren't quite there. So what I am going to do then is I'm probably just going to look into selling a naked put. And that's because I don't think we're going to break out to new highs, but I still think we're bullish underneath the gap. So this gap broke out at 225. I'm going to see what I can get here. Premium's really juicy. Let me erase these right here. I can get an 11 delta put for probably 275. So a 207.5 put, that puts us right down here, right? We're below the gap up. We still have a lot of room to the downside. We're 207.5, and this is in June, right? That's next week, right? It expires before the 22nd. So we still have that bullish buying pressure. Our option would expire before June 22nd, and we can sell an 11 delta put for probably $2.80, right? That is the trade that I am going to make. So guys, now that we've found the trade that we're going to make, which is the short put sale, let's be clear about these risks. Risk number 1, the stock is already priced in a lot of the good news, right? So if you're looking at the straight up buying a call or a long call vertical, that might be tough, right? It might be tough to make money on that, especially because the IV is so high, right? Because Marvell is up, it's up 210%. It already popped on the S&P 500 announcement. The valuation is stretched, and at 99 times earnings, there's not much cushion. So that's why the short put looks like a much better play, because we should still have some buying pressure, right, into June 22nd, which will keep the price elevated, so it shouldn't crash down below our short put strike. So if anything, guys, right, if anything hits this AI infrastructure trade, we could have a big sell-off and be in some trouble. I don't see it happening before June 22nd. Okay, risk number 2, like we talked about, the options are expensive here. The market knows June 22nd matters, and you're not discovering a secret catalyst. Everybody knows about this. So if you're buying calls, you need the stock to move enough to overcome the premium you're paying. And I determined it's not juicy enough for me. That's why either spreads or a naked put is the better option. Sell a cash secured put if you need to, right? That's a good choice right here. Risk number 3, right? Buy the rumor, sell the news. This is a real possibility. Marvell could peak before inclusion. We saw the thing already hit $325, right? That could be the peak. It may not hit above that before June 22nd. So understand when you're setting up your trade that we might not break to new all-time high, especially since we're down at 254. Again, that's why the short put makes sense here, is because I think we're going to stay elevated at or above the gap, and not drop down, before the window closes. So guys, my personal take here, right? The interesting window is the next 10 days. I am trading this. I am going with the short 207.5 put expiring on, what was it, June 18th. That's what I'm going with. And I'm not going to overstay this trade, right? It is a catalyst setup, not a marriage. As always, guys, I'm not a financial advisor. This is not financial advice. This is a trade idea. Do your own research. Never put more into one trade than you're comfortable losing. So guys, my name is Luke. This is the Option Bomb, and I will see you in the next one.